Right, so the rest of this is really talking about each step of the process and some caveats, qualifications, little things to consider with each step. So we'll start, of course, with step one. And I took this from the Accounting Standards Codification. It was area topic section, area 606, topic 10, section 25, paragraph 1. An entity shall account for a contract with a customer that is within the scope of this topic when all of the following criteria are met. All right. The parties of to the contract have approved. They are committed to perform their respective obligations. So the seller is going to fulfill and is beholden legally to fulfill its performance obligations. And the buyer knows their obligation, how much they have to pay, the form of payment. When each party is committed to this, perhaps it's in writing, perhaps it's orally, or it could just be in the context of a standard business transaction of that industry, right? So, for example, when I buy a cup of coffee, super simple, very normal industry transaction for coffee sellers, we've made a contract when I say I want a large coffee and they say that'll be $10, right? We're orally committing ourselves to this contract, right? There, I don't have to sign my life away. There's no paperwork, right? The big hiccup here is there cannot be a unilateral right of cancellation. Unilateral right of cancellation. What does that mean? That means one of the two parties can't just say, I'm out, right? No, don't want to deliver your coffee. I'll take your $10, right? No, that's not how that works. So if the buyer can cancel at any moment without a penalty, then there is no contract, right? We don't recognize revenue until there becomes a penalty for cancellation, right? Whether that's a restock fee or a shipping fee that has to be paid or a deposit that has to be surrendered, then we are not under contract. The entity can identify each party's rights and payment terms regarding the goods or services to be transferred, right? So, what are the legal rights here? What are the payment terms? We have to have everything clearly spelled out if it's not all being delivered up front in exchange of a good for cash. That can become problematic if the cash and the good are not exchanged at the same time. The contract has to have commercial substance. That means that because of the exchange, because of the contract, cash flows are expected to change as a result, right? So we're not selling something to ourselves. We are not inventing a company to sell our item to only to take that cash back again, right? That is not a contract. That's called, financial manipulation, uh, rigging or engineering a transaction to a false, fictitious transaction that has no overall impact on the cash flows for the buyer or the seller, right? The final one relates back to realizability. So it has to be probable that the entity will collect the consideration it is entitled in exchange for the goods or services. So there has to be a high likelihood that me as the seller can collect and that the buyer is going to pay, right? So that goes back to that idea, are we entitled to receive what we expect to receive? Right? And this under IFRS and GAAP can be a little different. IFRS says that probable is just greater than 50%. GAAP is a little bit more stringent. So there can be cases when probable will meet IFRS, but not GAAP. Right? Just kind of, it's not a hard and fast rule, but GAAP tends to define 50% as more likely than not, but not yet probable. Okay. So let's look at a contract. So we are a commercial real estate. where we're selling commercial real estate, right? We're selling property for $1 million. We collect a down payment of 150, and the person who bought it is financing the remaining amount with a loan. So our ability to realize the total 1 million, we only have 150 that they put down on it. Our ability to recognize the full 1 million is going to depend on whether the buyer is able to pay off their loan. Because if they're not, then the property is going to be seized, you know. The buyer intends on starting a restaurant in the commercial space. They have no prior experience in the industry, and competition in this location is high. And there are no other substantial sources of income and no other investees. So the person that we are transacting with, we probably shouldn't have made this deal with in the first place, but the person that we're transacting with has no one else to help, no other fail safes, no other job that's bringing in money. It's all going to depend on this restaurant. Is this an established contract? Should we, the commercial real estate company, recognize revenue for this sale? And if so, well, how much? So, I mean, you're going to hate it probably because most accounting students do, is that it depends, right? It depends on a few things. If if the location reverts to the financer, which it probably would, then the financer, right, could pay us and assume control of the spot that we sold to this restaurateur, right? The restaurateur isn't occupying it, but it is being passed along to the financer. So if the restaurateur fails to pay, the location reverts to that person. So think of, for example, if you fail to pay a mortgage, your house goes to the bank that the mortgage was agreed through, right? So then in that case, if it's going to the financer, we still got our money because they financed this space by going to a financer, then we can receive all the money. But if the deal falls through, and for example, the buyer doesn't want in the case of the mortgage, the bank doesn't want the house, right? They don't want it. That wouldn't really happen in there because you're only talking about the bank and the buyer. But yeah, if this comes back to us now as the commercial real estate and we have to resell it, well, then that's not going to work for us. We can't record money because we're probably just going to get this back. The guy has no experience in the restaurant industry. Competition is high here, right? It's likely this person is not going to make it, is not going to be able to pay $850,000 that remains. And in that case, if the financer isn't taking control of this location, then it would revert back to us. And therefore, really, if the financer is not taking control, which would be really weird, I admit. We will only recognize what was paid for, the $150,000 that we received. Okay. But if the location reverts to the financer, we as the commercial real estate received all the money. It's out of our hands now. It's really just between this restaurateur and the financing company, then we can recognize all the revenue. Right? There's also aspects of control within this, right? Because if we've received all the money from the financer, hey, we're done, right? This is now really the property of the person who financed the restaurateur. we're not getting it back. We've relinquished all control, right? Then we can, we have received the money, we've relinquished control, we can recognize that as revenue. Because remember, control is big in establishing that contract. If the financier is not taking control and the restaurateur has only paid us $150,000, they're paying the rest of that money, the 850 to the financier. We still control the location, right? If they're not wanting to take control of the location, then we still control it. We can only recognize what we've been paid for, what's actually realizable.